All right, I think we'll get started with the webinar for tonight. I know it's a beautiful sunny day, at least where I live, and some of you may still want to enjoy the rest of the day. So we're going to get right into it. This webinar will probably take about 45 minutes. It's a relatively short topic. If you participated in the webinar that I did last month, which was on active trading, portions of this webinar are going to be similar. Some of the stuff regarding risk reward and that kind of thing is the same, whether I'm day trading, swing trading, or long-term investing. But this webinar is going to focus on the investment process that we use on Stockscores, using the Market Scan tool either on a daily or weekly basis to find stocks for the longer-term trader, someone that maybe is buying stocks for the retirement portfolio, or just longer-term stuff where you're not watching the stock minute by minute or even daily. Some of these strategies you can do just by checking the market a little bit on the weekend. All right, so let me just get my presentation going here. So the itinerary for tonight, I'll do a little introduction on myself, explain a little bit about the concept, the sort of theoretical background behind the Stockscores approach. I'm going to talk about how I measure performance, because it's important when we get into understanding the strategies and the economics of trading, and so we'll talk a little bit about that. I'm then going to show you the processes that I use for finding trades, and that's really the meat of this presentation, is to show you the Market Scan tool and how easy it is to implement the process, the strategy, and ultimately find stocks to buy for that position trader. We'll talk a little bit about the components of the Stockscores approach to investing. I have many people that want to learn how to do what I do, and we have educational programs for that, so I'll describe some of that in the How to Become a Stockscores Investor. All right, so a little bit of background on me. I started trading when I was 19 years old, which means this will be my 25th year trading the market. When I started, I was pumping gas at a gas station in Calgary, student at the University of Calgary, didn't have a lot of money. I started with about $3,000 of capital, some of which I borrowed from my credit card, and bought my first stock. I lost money on my first stock, but I would say, hooked on the market and the idea that I could make money simply by buying and selling stocks. So I stuck with it all throughout university. I traded the market, sort of paid my way through school, and then when I graduated from business school, I couldn't get a job, so I kept trading the market and built the Stockscores website and started writing books about the stock market. I had a fairly good following in Western Canada, and people wanted me to teach them, so I started doing that, and that's sort of the evolution, if you will, of how Stockscores came to be. I originally built the Stockscores website and the tools on Stockscores because I needed something that I couldn't find anywhere else. I wanted a way to search the market for the kind of opportunities that I like to trade in a very quick and efficient way, and of course the internet was just sort of becoming popular when I first started trading, so I was able to build something that wasn't really around, and many of the tools that we still offer are pretty unique to Stockscores, and I'll show you those things tonight. As I said, I developed education back in early 2001. I taught my first course in Calgary, and typically in a year I'll teach 100 people my approach to the market. Most of my days are spent trading the market. I sat in front of the screen all day today and traded the market. I live on the West Coast, so I'm able to be done my trading day at 1 o'clock, and I live on a lake, so I was able to hop out on the boat and pull kids around on tubes this afternoon. It's a nice lifestyle. We start the day here at 6:30 in the morning. All right, so what is the Stockscores investing concept? Well, the first thing that you need to understand is that most stocks, most of the time, are not worth trading or investing in, because most stocks really perform the way the market does. They're not going to beat the market. And what I mean by that is if the market goes up 8% in a year, the typical stock will do the same thing. Now, some stocks will underperform the market, and some stocks will beat the market. And what I want to do is find the stocks that are likely to beat the market, because if I can't do that, I may as well just buy an index ETF like the S&P 500 ETF or the TSX 60 ETF and just do what the market does. And in the last few years, because the market's been doing very well, that has been actually a very good strategy. But if the market earns 10%, and if I can find some stocks that on average earn 20% or 15%, well, then I've really beat the market. And that has a significant effect on the compounding value in a portfolio. You know, if you can beat the market by 1 or 2% a year, it has a huge effect over the lifetime of a portfolio. And you can do even better than that. If you can, you know, do 15 or 20% a year because you are a small investor, you can be nimble, you can move in and out of stocks much quicker than a large fund could. You know, individual investors have a lot of advantages because we are small relative to big investment funds. So that's my whole aim, is to find stocks that are likely to beat the market. And I'll show you a few examples tonight. And over the last 25 years, I've developed a methodology that focuses on some very simple things that help me find market-beating stocks. But I want to really emphasize this. There's more to trading the market than buying the right stock. You know, when I started out investing in stocks when I was in university, I was always focused on buying the right stock. And I was actually a very good stock picker back then, but I didn't do great because I wasn't a good risk manager. And that's a big part of what makes any investor successful, is the ability to manage risk, to know when a trade isn't working and to just cut it loose and take a small loss, and also to know when a trade really is working and to ride it out and enjoy a larger gain. If you're going to invest well over the long term, it's absolutely essential to preserve your capital. And my approach, the most important thing in all of it, is preserving capital, not taking on too much risk and not seeing your principal get devoured by mistakes. And you know, many investors approach the market with what I'm going to call a gambler's mentality, where they're, you know, buying stocks on tips, on hunches, and that sort of thing, and they often are doing no better than what you would do in a casino. So my approach is very methodical, very mechanical, and again, I want to stress that it's really focused on managing risk. Emotions are a big part of trading the market. You have to be able to overcome your emotions when you are trading. And we'll talk a little bit about that as I go through tonight. All right, so most market-beating stocks have the same footprint. They have the same signal. If you go look at the top, I'm going to say top 50 best performing stocks in the market last year, you'll find that probably 45 of them will show the same characteristic early in their upward trend. And that characteristic is abnormal activity. And it doesn't matter whether I'm day trading to hold a stock for an hour, whether I'm swing trading to hold a stock for a week, or whether I'm position trading to hold a stock for months or perhaps even years. All of these market-beating trends start with abnormal trading activity. Now, what do I mean by abnormal trading activity? I mean the stock goes up faster than normal on a particular day. It trades much more volume than normal on a day or week. And these are the footprints of stocks that are going to beat the market. And the reason, it's relatively simple. Stocks beat the market because their fundamentals, their business, is doing really well. You know, if an oil and gas company starts finding big oil deposits, well, that really improves the fundamentals of their business. If a biotech company develops a new drug that's going to cure a disease, it's going to have much more profit in the future, and therefore its fundamentals are improving over time. And the way the market works is it's really a discounting mechanism for information. There are thousands and thousands, if not millions, of people investing in the stock market every day, and they are all trying to digest all of the different sources of information that are out there to figure out what it's all worth. And when a company has improving fundamentals, it's the people that follow the company the closest that will get that information before anyone else. And when they have that information, they act in the market aggressively and they create the abnormal activity that I look for. And as we go through examples tonight, you will see that over and over again, What I'm really looking for is stocks that nobody really cared about, stocks that are trading in a boring, sideways sort of trading pattern, and then all of a sudden they come alive with abnormal trading activity. And the reason they come alive is because the people that follow that company the closest have found some new information that justifies them paying a higher price for the stock. And what I do is I search for that abnormal activity. And the Stockscores Market Scan tool, which I'm going to introduce you to tonight, allows me to scan through the entire market of every stock that trades in North America looking for abnormal trading activity. However, not all abnormal trading activity leads to big price moves. So while most market-beating stocks will start their trend with abnormal activity, not all abnormal activity leads to these big price moves that we want to enjoy. And so therefore, it's important to know how to not only look for abnormal activity, but to filter out the garbage among the stocks that are trading abnormally. And that really comes down to being able to read chart patterns and to determine risk and reward for trades. And I'll walk you through some trades that I did in this last year here. The first example is a stock listed on the Toronto Stock Exchange called Bankers Petroleum. And I want everyone to sort of focus in on where my arrow is here. Actually, I'll take out my little drawing tool here. Right in here on this particular day, or this is actually a weekly chart. So in this particular week, that stock made a statistically significant abnormal price gain, and volume was higher than the previous 4 weeks. On an individual day during that week, it was behaving quite abnormally. And that really started the upward trend. Now I'll get back to this chart later on, but that's what I want you to focus in on, is here's a stock that went from roughly $3.50 to $7 in less than a year. So it's doubled in price. It's not a high-risk stock. This is an oil and gas company. It's hardly a penny stock or anything like that, but it has done very well in the last year, and it all started with the abnormal activity. Here's another example of a Toronto-listed stock, Altus Group, and it too, on a weekly chart, made some abnormal activity right in here, and combined with these lines, combined with the pattern that came before that, that really told me that that stock has a high probability of going into a market-beating upward trend. And again, in less than a year, or about a year in this case, it has gone up better than 100%. And it all started with abnormal activity. Now we'll come back to these two charts once I've taught you a little bit about what to look for. Before I do that, I want to talk a little bit about how I measure performance and the economics of trading. Most people will measure their performance in terms of percentage gain, in terms of dollar profit. So they might say, well, I made $1,000 on this trade. The problem with that is it doesn't really give much consideration to the risk you take. If you make $1,000 on a trade where your potential loss was $2,000, you really haven't made a great trade. You've only earned half of what you risked. And what we really want to do is have trades where we earn a much higher multiple of what we risk. So if we risk 1,000 and we make 5,000, well, we've made a good trade. But if we risk 2,000 to make 1,000, well, that's not such a good trade. So we refer to that as the reward for risk measure. And I always give this as a number. So if I make 5,000 after risking 1,000, I've made a reward for risk of 5. If I make 2,000 after risking 2,000, then I've made a reward for risk of 1. It's always the reward divided by the risk. All right. So we want to not only keep this in mind, this idea of reward for risk, but also recognize that anyone can get lucky or unlucky on a few trades. But to be a successful investor, you have to measure your success over a large number of trades. If you've got a set of rules that you use that you find works over 50 trades, 100 trades, then you've got a strategy that has a positive expected value. All right, so that's real important is to measure your success over a large number of trades. And I've seen countless times people make a whole bunch of money on one stock and they think that they know what they're doing in the stock market. What really was happening is they got kind of lucky, or they rode a hot trending market, and then the reality sets in that they really don't know what they're doing and they don't have a strategy that works over a large number of trades. So when we're buying stocks or shorting stocks for that matter, we always want to have a set of rules that works over a large number of trades. Now this leads us to the next question, which is, can you make money by being wrong more than you are right? Now most people would say no. Most people think that to make money in the market you got to be right more than you're wrong. And in fact, many investors try to do exactly that. However, most professional investors actually don't try to be right all that often. I have friends who are professional money managers, and some of them are wrong 80% of the time, sometimes even more than that. But the difference is that they make a lot more when they win than they lose when they are wrong. So let's go through a little example of that. Suppose you did 100 trades or 10 trades. And on those 10 trades, 6 out of 10 or 60% were losers and 40% were winners. Now, your average loser, let's say it was $500, but the average winner was $1,500. So here you've got a losing percentage, but ask yourself, how much would you make or lose after 10 trades? Well, let's go through the math together. If 6 times we make $500, or pardon me, if 6 times we lose $500, so 6 times we lose $500, we have $3,000 in losses after 10 trades. On the other 4 trades, we made an average of $1,500, which means we had $6,000 in profits after those 10 trades. The net result is that after 10 trades, we've actually gained $3,000, even though we were wrong more than we were right. The key right here is to take small losses and have big gains. We want to have stocks where we have a small risk and a much larger reward. And if you can develop a strategy where your reward size is significantly bigger than your loss size, then you don't even have to be right all that often. And some of the best traders are those who take small losses and very big profits, and they're not even right all that often. Let's continue on with some of these economics. Out of 10 trades, for me personally, I find that I often sort of get these economics, where out of 10 trades, I'll have 2 bigger winners, which are stocks that make me anywhere from a risk reward of 5 to even 15. And out of those 10, I'll have 4 or 5 relatively small losers and 3 or 4 smaller winners, where the risk reward is only 1 to 4. Well, what I find is that the small winners and the small losers tend to balance each other out. So these 4 or 5 losers and these 3 or 4 smaller winners, they tend to kind of balance each other out. However, my 2 big winners are where I make all my money. And so after 10 trades, or 100 trades, whatever the number is, that's where the positive expected value comes. Now, that sounds relatively simple, and I think a lot of people can appreciate that, but I don't think most people appreciate how difficult that is to do. Because if you are a normal human being, a normal emotional person with an emotional attachment to money, you will have a hard time taking the small losses, and you will have an equally hard time holding on to the big winners and letting them do their thing along the way, even though there's inevitably pullbacks along the way that will make you nervous. So, as a trader, you want to keep this in mind. The economics of trading, you have to understand your economics of your strategy. Whatever strategy you use to trade the market, make sure that you have one where your expected value over a large number of trades is positive. All right, now let's get into a little bit about what I look for before we do the search process. Excuse me. I like to look for signs that investors are excited about something. A stock that nobody cared about and then starts to heat up with some abnormal activity is one that's telling me that there is some significant fundamental change going on that is important. And these stocks that show this abnormal activity are only good if that abnormal activity is coming from a predictive chart pattern. Now, what are the components of a predictive chart pattern? Well, typically we want a breakout through resistance. We want that breakout to be from low price volatility, which is another way of saying a stock that's been trading sideways. We want optimism, and we know that there's optimism in a stock chart when there are rising bottoms on the stock chart. And as I said, we want that breakout through resistance, from optimism, from low volatility. And to help us find these, we're going to use the stock scores indicators when we are position trading. We want to see the sentiment stock score greater than 60 and the signal stock score greater than 80, because these indicators were developed to look for breakouts from low volatility from optimism, plain and simple. So when you have rising bottoms on the chart, you have optimism, the sentiment score is going to be above 60. When you have breakouts through resistance with abnormal activity, you will typically see that signal stock score spike up above 80. All right, so let's go back and look at some examples again. So here we are, Bankers Petroleum. We've got rising bottoms on this chart. The stock was generally going sideways for over a year. And then finally we had the breakout right here with some abnormal volume, abnormal price action. And notice that the stock scores, which had been kind of languishing for a while, suddenly started to move up. And now they were above 60 and above 80 on that particular week as the stock broke out from that predictive chart pattern. And the result was that this stock went up quite steadily. Now, how well did this stock perform? Well, one of the things we have to consider is the risk of the trade. So if I buy the stock here and I plan to take a loss down here, and there's a method I teach for why we would take a loss there, then I know that my risk is that amount, which is about from $3.50 down to $3, or about 50 cents a share. All right? Now, as the stock climbs, it's basically climbing multiples of that space, multiples of that risk amount. And I apologize that I'm not drawing these lines very straight. But as it stands today, that trade is roughly up a reward for risk of 1, 2, 3, 4, 5, 6. So right now that trade is up, not only is it up about 100%, but it's also making 6 times the risk. So if you risked $1,000 on the trade, you're currently looking at a $6,000 profit because it's up a reward for risk of 6. All right? And how we size our positions and why we put our stops there, those are all things that I teach in my investor course, but I just want to identify sort of the thinking that we have to apply when we are looking at these trades. Let's look at the other example. Here again, you see the abnormal activity right there. You see the stock scores have been climbing steadily, so they're above the 60-80 threshold on that particular week. All right, and we have a predictive chart pattern. So what's our predictive pattern? We've got low volatility, boring sideways trading. We've got bottoms that are generally rising over time, so we have optimism. And then we have the abnormal activity breaking us out from that chart pattern, and that ultimately led to this market-beating gain. Now, what is our risk reward on this trade? Well, if I'm going to buy this stock here, and my stop loss is going to be about here, let's just take that same space. That's a reward for risk of 1, 2, 3, 4, 5, 6, 7, 8. We went up to about 9, maybe even 10, and currently it's sitting at about 8. So this trade is making a reward for risk of 8. So if you risked $100, you're up $800. If you risked $1,000, you're up $8,000. If you risked $10,000, you are up $80,000 on that trade. All right, what do we look for? Good stock scores, good chart pattern, abnormal activity. And then finally, we want to make sure we've got a reward for risk potential that justifies taking the trade. All right, so there's thousands of stocks out there. How are we going to find these stocks in a timely way? Well, that's what the Stockscores Market Scan and the Stockscores strategies are all about. Now, those last two examples, I would typically find those by doing a process every weekend. So either Friday night, Saturday morning, Sunday afternoon, anytime on the weekend, you're going to go into the Market Scan tool, and you're going to select one of these Pro scans. So if you're a Pro member of Stockscores, you can select the Stockscores Simple Weekly Strategy. So I'm going to select that, and I'm going to apply it just to the Canadian market, and I'm going to run the scan. Now actually, before I do that, I need to set up my charts on a weekly time frame. So I'm just going to call up a chart of any old stock. All I did there was enter a symbol in the top right here, called up Microsoft, and I'm going to change this chart to a weekly chart. Okay, so I'm going to change the interval to weekly. I'm going to make the chart go back 3 years. Now again, what I'm showing you right now is a process that you would use if you are a longer term investor who wants to hold stocks for weeks, months, well not weeks, months or years, all right? And you only have time to do the work once a week on the weekend. That's this particular process right now. All right, so let's go back. Market Scan, select Stockscores Simple Weekly. Let's run it just on the Canadian market for now and run the scan. And it found 12 candidates. Now our next step is to inspect these charts to see if they have the right kind of chart pattern. So I'm going to view these stocks in a slideshow, and we're going to go through these charts looking at the pattern to see if we have a break from low volatility through resistance from optimism with good stock scores. All right, this one doesn't really cut it. It doesn't have that pattern I want. Now this stock may be a good swing trading stock and maybe a good day trading stock, but for the longer term trader who doesn't want to watch the stock very closely, it doesn't suit right now. So we go on to the next one. This stock was a good one 3 weeks ago, and if you read my weekly newsletter, you'll know that I highlighted this stock 3 weeks ago, and since that time it's risen probably 10% or so. Why? It was trading sideways, it had optimism, and it broke out through resistance to $1.10. So at that time it was good. It's already up about 10%, so I feel like maybe the bus is leaving the station already. And that's really the process. Is now what we're doing is we're cycling through these charts one at a time, looking for what I teach you to look for, which is a break from a predictive chart pattern. And it takes some practice, but once you get good at it, you can go through charts this quickly looking for those right kind of chart patterns. And when you see one, you'll know it because they really just jump off the page. Trans-Canada Pipeline did a pretty good breakout last week. I was tempted to put that in my newsletter as well, and I opted not to just because I felt like this stock has already gained quite a bit over the last few years, but it has done quite well since. Okay, that is the Stockscores Simple Weekly Strategy for the Canadian market. Now let's say you're a trader who wants to do this every day. So you can be a little bit more active. You can make your money turn over a little more actively, in which case you might be able to pull out a better return out of the market. If you're going to be that kind of a trader, then I recommend doing the same strategy, but on a daily interval. So the first thing we have to do is change our chart back to daily. So pull up any chart, go down to the charting tab, and let's change this back to daily and make it an 8-month chart. And click on Create Chart. And now we have set our default to an 8-month daily chart. Now when I go into the Market Scan tool, I'm going to this time select the Stockscores Simple strategy. So not the weekly, but the Stockscores Simple. And this time we'll run it on American stocks, but let's pick stocks between $1 and $10. We can add different filters in here. You'll see some things are highlighted in green. Most noteworthy, the signal score is better than 80. Sentiment is between 60 and 85. And let's also say that the stock has to trade at least 1,000 times a day. Run the scan, and it found 7 stocks that meet those criteria. So I can say select all, and this time I'm going to view them in a gallery rather than a slideshow viewer. So I'll click on Go. And now I can view these charts a little more quickly because we've got 10 charts to a page. But again, same concept. I'm looking for a predictive pattern with a breakout. And when I see one, this one's not bad, it's not great, but you can see there a little bit of abnormal activity today from some sideways trading. My reservation is it's had a tendency to get stuck at $9, so I'm not sure that it will break out through that. But that's really the process. We select a scan and we go through charts. When you see a chart you like, you can click on it, make it a little bigger, or move on to the next one. Now the last thing I want to show you for process is one more market scan for the investor, which looks for stocks paying a dividend. So, pardon me. when we run something like the Stockscores Simple Scan, we can actually add in the ability to only look for stocks that pay a dividend. So we can select the Stockscores Simple strategy, but put in that they must pay a dividend and the yield must be at least 3%, but just so we don't get some of the garbage that is going out of business, we'll say a yield of less than 10%. And again, I can add in other filters if I want. I'll make this 1,000 trades here. And this time I'll look for stocks between $10 and $25. Run the scan. And it found 5 stocks for me to look at. So I say select all. I can view them one at a time in the slideshow, or I can view them 10 at a time in gallery. I'll do the slideshow this time. Click on go. And now you can quickly see whether that has a right chart pattern. If I go to gallery, I can actually also see what the yield is. So you see right here, it shows me that the yield on this stock is 3.7%. Here's a stock breaking to new highs from optimism. Not a great pattern, but not bad, paying a yield of 3%. So for the investor that's looking for that pretty good yield, in addition to the potential for capital gain, here's a way to do that. Now, if I like a stock, I can add it to a watch list or put it in a portfolio. So I could add it to a watch list. We'll call this July test. Click on go. And now I'll be able to go back to it later. So I've got lots of options when I'm using the Stockscores website doing this process. Okay? All right. So I'm going to jump back to the presentation here. And that's really what I wanted to talk about there, whether you're looking for just capital gains on your trades or whether you're also looking for yield. All right, let's continue on into the next slide and talk a little bit about the components of a trading approach. When I pulled up that market scan tool, I had some preset strategies in there. And that's really something that I love to do, is develop strategies. My focus is in creating strategies that I test exhaustively to find those that will earn me a good profit if I do it 100 times. In addition to having a strategy, you also need to have the skills in applying the strategy. So because I'm a technical trader using charts, I have to have chart reading skill. If you're a fundamental trader, you have to have knowledge about how to apply fundamental analysis, and you also have to have good information. So my approach, I think, is accessible more for the retail investor who doesn't have that level of expertise in an industry or doesn't have the information, the access to information, or the resources to get good information. My approach is basically following the people that have the best information, because when the people with the best information act in the market because they have something good, they create the abnormal activity that I follow. So you need a strategy, you need some skills, you also need a process, and you need tools. And so I've shown you my process, which is relatively straightforward. Anyone that practices this for maybe a month can get used to using that tool and how to run the process, whether you do it every day, whether you do it on the weekends. There's even some ways to approach the market where you only do it once a month. The tool that I use, the Stockscores website, really gives me that advantage because I can go through thousands of stocks every day, every week, every month in a relatively short amount of time looking for the right kind of trade. Of course, we also need to have emotional control and discipline. If you don't have the discipline to follow the rules of your strategy, then what's the use of having a strategy? You need to write a trading plan and follow that plan effectively. And of course, you also, if you're going to invest in the market, need capital. And as I said earlier, when I teach people, what we really focus on is capital preservation. We don't want to take big losses. Not to say we won't take losses. We don't want to take big losses. We don't want to have those portfolio crushing losses that can really hurt us. So how do you get there? Well, there's basically two ways. There's a way I did it, which was teach myself how to do it. I spent at least 8 years learning how to read charts, learning how to manage risk, how to manage my emotions. I spent hundreds of thousands of dollars developing my own tools, which is the Stockscores website. I've spent countless hours developing processes, countless hours developing strategies. And I love to do it. I've been doing it for 25 years, not because I need to, but because I love to do it. And so I continue to do these things. I continue to develop new ways to read charts, new tools, that sort of thing. Most people don't have either the time or the interest to do that. So what I've developed is the Stockscores Investor 12-week training program. I'll talk a little bit about that now. My training program is, I think, unique in that it's a one-stop shop. I've seen so many companies who teach people how to invest in the market where they have all these multiple levels. You start with this free entry level, and then you take kind of a cheap level, and then you come to that class and they say, oh, by the way, you need this class. And I've had people come to me who told me that they've spent $20,000 going through an education program that was complex, was confusing. At the end of the day, they're really not that great of an investor. What I aim to do with a relatively small number of people is teach you my method in one class. I'm not going to say you need to have this other class and you need the third level. It's if you take my investor course, you get everything that I do from me. I will guarantee you that it will cost you significantly more to teach yourself this stuff than to do it by taking my course. The course has the following components. I teach you my strategies. We start off with some basics. You read my Mindless Investor book, which is very basic. You then go through the foundation course where you learn how to read charts, how to manage risk, the processes to find trades, how to build a trading plan. It's all on videos, books that accompany the videos. Once you do all that material, then you start your 12 assignments. So when we call it a 12-week program, it's because there's 12 assignments. It doesn't have to take you 12 weeks. It can take you 2 years if you want. It can take you 12 days if you want. It's how quickly you want to work through the assignments. Each assignment will take about an hour. So however you fit that into your schedule is up to you. We make it a 12-week program so it's not overwhelming for anyone. But certainly I've got lots of students that do the assignments in 1 or 2 weeks because they're really gung-ho and want to get at it. Once you've done your assignments, once you've read the books and watched the videos and asked me questions by email back and forth, you then work on your trading plan. And that's where I get a little more involved because I will have a little information session with you to help you focus in on the right strategy for you, for your personality, for your capital base, for your investment goals, for your age, for your risk tolerance. We'll create a trading plan for you. So all through this 12-week program, you get support from me, mostly by email. So when you have a question, you email me and I give you an answer within the day. But certainly at a certain point, we do a little online meeting, one-on-one, where I can give you a little bit of help. This is for the home study version of our course. So the home study course has a cost of $2,495. It includes all the course videos, the books. It gives you 6 months subscription to trade Stockscores.com plus a preferred renewal rate of $300 a year. 6 months subscription to my daily market commentary, a little educational piece that I put out each day along with my stock picks. You get that for free for 6 months, and then you can renew that at a discounted rate. Unlimited email support from me. I've had people that ask me 3 questions a day. Doesn't matter, you just fire them off in an email. Because I trade all day, I sit in front of my computer all day, I've got the time to answer a lot of questions. Some people would like an even higher level of support from me. So if you want to be able to have one-on-one coaching on an ongoing basis for 6 months, then you can do the mentorship option as well. That has a cost of $7,495. It's the exact same material as this course. The difference is it's just way more of my time, and that's why the cost is much higher. So how do you do this? If you would like to register for the Stockscores Investor course, or if you would like to register for the Active Trader course, which is the other option, what I recommend you do is go to this webpage, stockscores.com/learn, and on that page you will be able to sign up. But there's also a couple of videos on there that you can watch, and I will be emailing you a video of this webinar today. If you felt like it went really fast, that maybe you missed some things, don't worry, because I'm going to email you a video of it as long as we don't have any technical problems. So on this page you can watch a video on the investor course. You can also watch a video on the active trader course. It's very similar to what I talked about this evening. And then if you want to register, you simply log into Stockscores, click on the register now button, you can go through that. Of course, many of you probably, if you have an interest in this class, want to ask me some questions first and make sure that this is right for you. I'm happy to answer as many questions as you want. You can email me at tylerb@stockscores.com. If you'd rather do a phone call, we can do that. I don't do any pushy sales pitch on the phone or even an email, really. I only teach a small number of people every year. I got lots of students, so I don't need to force anyone to take my class. You can email me, tylerb@stockscores.com, and we can either set up a phone call or you can just ask me questions that way. So there's my contact information. Something I really recommend you do is go to YouTube, youtube.com, and enter the address you see there on the screen, which is the stockscores.com, spelled out like that. And you can see the YouTube channel that I have. And on the YouTube channel, there's, I think, a few hundred videos that I've created. Every week I do a new market video where I do some analysis of the market, have a little trading tip, and it's a great way to kind of get a sense of how I approach the market. I also have a Twitter account that I put out the odd tweet that you can follow as well. Now what I'm going to do now is answer any questions that have come in. If you have a question, go to the little dashboard box that you have for the webinar, and there's a little question box on there. If you submit a question in there, it will come directly to me and I'll be able to answer you verbally. There's a couple of questions already, and I'm just going to take a moment to read these, and then I will answer them if I can. So what about stocks going down? Their abnormal activity isn't improving fundamentals. So if stocks are in a downward trend, then you lack the optimism that we look for. You have pessimism instead, and they might have abnormal activity to the downside because the fundamentals are getting worse. And of course, that either is a reason to sell the stock if you own it, or even possibly go short the stock. Now, when I was doing these market scans for you, I only focused in on some of the buying strategies, but when you take one of my classes, I teach a lot of different strategies, and so there are other strategies in here that we use. So for example, abnormal activity down is a way to find some stocks that may be good short strategies as well. All right, I got another question coming in, and again, if you want to type in a question, please feel free. You can also email me questions after the fact. Is there a way to jump in the market early in the morning, the day after solid earnings, blah, blah, blah? So one of the strategies that I love to do, and this is an investment strategy, not a day trading strategy, but I like to try to find these stocks that are making these abnormal moves earlier in the day. It gives me sometimes a bit of an advantage to finding those stocks over someone who has to do the work in the evening. So I've got a little scan here for that. Again, it's going to the Pro Scans, and you'll see here I've got this Morning Simple Canada and Morning Simple US. So each morning I'll run that about 45 minutes after the open, and it will allow me to see the stocks that are moving early in the day so I can try to jump on them before they've made big moves through the day. Now again, that's not for everyone because you have to have the time early in the morning to do that strategy, but it is a good way to find those things a little earlier. Hopefully that helps answer your question, Eric. Steve is asking, can you do practice trading with Stockscores? I built a trading simulator. It's not at Stockscores, it's at another website that I own called tradescores.com. So a few years ago I invested a few $100,000 in the TradeScores Trading Challenge, and it's a little tool where you can do fake trades. So it's a free website to use. Just go register at tradescores.com, and you can do fake trades in there, and it tracks your results and allows you to compete against other traders on the simulator. So we can go into this person account and see what trades that they currently have open, what trades they have closed off, and it really allows you to track your trades in a non-risk fashion. It's free to use, and it's a great way to track your performance over time and practice. I've got a question here. Can you take your mentorship course after an active trader course and pay the difference? Yes, you can. So if you wanted to do the active trader class and then upgrade to the mentorship later, you can just pay the difference. And I have quite a few people that do that. They want to take some time reading the books and then upgrade at a later date. So you know, the active trader course is $34.95, and then when you're ready to have my coaching, then you just pay the difference and we get on the coaching process. So I've actually just got one student who's doing that right now who took the active trader course some time ago, and now we're in the coaching phase. Hopefully that answers your question, Ivo. I don't see any other questions. I'll pause for another moment. Let me see if there's anything else I can show you on the Stockscores website. I didn't go into all the tools. There's a lot of different tools on here. And you know, you don't have to take my class to use all of these tools. Some of these tools are for members only, but others you can use for free. And some of them you can use in a sort of a light version if you have an advanced membership. So you can go into the products area and look at the different membership alternatives. When you go into the products under educational, you'll see something here called Pro. That's been replaced by the investor course. So we haven't changed the website yet because we're doing some reworking of some of that education right now. But if you want to do the class, the Pro is essentially the investor course. The active trader adds some other features into the education process. I don't see any other questions rolling in, so I am going to end this. It's exactly 45 minutes since I started. Someone is asking, so the Pro scan is only available if you take a course? Yes, the Pro level scans are only available if you've taken my investor course or the active trader course. There are some scans available if you take the advanced membership, but they're not the Pro scans that I was showing you tonight. Anyway, I'm going to wrap up. If you have any questions, please don't hesitate to send me an email. I'll put my email address up there one more time here, tylerb@stockscores.com. I am going to try to email a link to this video probably tomorrow. It takes a little while to edit and upload it to YouTube, but I will send it out to everyone that was here. If you don't get that email, check in your junk folder or the spam folder of your email program, because sometimes email from us lands in there. I want to thank you all for joining me tonight. I hope that it was educational, that you learned something, and I hope to hear from you soon with any questions that you might have. Have a great night, and as I always like to say, trade well.